Ken McElroy. We will go through exactly what he is saying. He put out a series of tweets on X over the weekend. And let me just start by saying, nailed it. One of the things you will undoubtedly see if you've been watching One Rental at a Time is we were calling for this real estate crash years ago. We were pointing out many of the same issues. We even related what was happening in the commercial real estate market with what happened in the residential market. And that is short-term debt, variable rate debt, bad assumptions, new investors, all of those things and more. And it's here. And when you have folks like Ken McElroy pointing at it and saying most people don't see it, it frankly, it does make me smile a little bit and recognize that you and I were ahead of the game. You and I were calling out the issues early, hopefully getting ready to take advantage of this. So let's talk about what Ken McElroy put out. Again, if you go on X, you can either follow myself, which I retweeted, or go directly to Ken McElroy. I think it came out on Saturday. So here we go. In 2021, properties were snapped up with 4% interest only variable rate bridge debt. Folks, that was the seed of the problem. Just like single family homes in 2006, when 51% of the loans were variable. Today, rough and tough, 96, 95% are fixed. So again, not the same problem. But in 2021, the seeds of the pain, the crash, were planted. And they will be born fruit in 25 and 26 because of interest-only variable bridge debt. Now the rates, this is all according to Ken McElroy, are over 7. And the numbers simply don't work. So here is the fallout. You might have had a $1 million property in 2001 or 2021, excuse me, where you got a 70% LTV loan. So you had to put $300,000 down. And given the cash flow, it would have been an okay deal. Now, with rates at 7, that same building needs $1.225 million, right, in cash flow to pay for it. So again, it is just not performing. Banks in these loans require a 1.25 to 1.3 DSCR loan. That's above the payment. That's the way it funds itself. So what are the sellers to do? This is the crash that's coming. This is the crash that's already here in Class A. And as I've been saying for 6 months now, Class B and Class C are not trading yet. But those are the opportunities for you and I. So, 1, the seller can sell at a massive loss. Not likely. 2, you can go back to your investors and beg, borrow, and steal to do a cash-in refi. Or 3, you default to your lender. I don't know. Sean, I don't know what's going on, bud. Looks like it's performing okay here. Hopefully it's your internet, not mine. So at the end of the day, there are going to be properties that are just simply not worth what the debt is. They are going to go back on the market, either by the owner or by the bank. Now, let me bring in a couple of things from my experience, because I have seen this before in small multifamilies. That's where I look. I do not pretend to be Ken McElroy, nothing even close. My largest building is 20 units, just to put it in context. What will happen is you will have owners list their property. In fact, many of them are listed today. They will likely get some agreement from their bank called extend and pretend. We'll give you 6 months to try to sell this asset. There is not a legit buyer on the market that will overpay. And eventually these assets will deteriorate because the existing landlord is only going to band-aid it. They will turn into slumlord properties, and they will be bought for pennies on the dollar. I give you an example that I bought last cycle. There was an 18-unit building listed at 1.44. It wasn't worth 1.44. Why was it listed at 1.44? Because that's what the owner paid for it. That's what the owner paid for it. It wasn't because that's what it's worth. It's because that's what he paid for it. It was probably worth at the time $1 million. But of course, the owner at the time didn't want to lose all that money. So he got an extension from the bank or the lender for a year. But of course, because he knew he was going to lose it, he stopped doing maintenance. And then he went back to the lender and got another extension. I think this time for 6 months. And by that time, the bank or the lender went back and evaluated the asset and realized they had a problem. They had to foreclose. It was now a complete slumlord, disgusting property. They took it back, foreclosed. We happened to have a building down the street. The lender reached out and we negotiated a price of $700,000. No money down. All we had to do was put $50,000 in this bank for repairs. That's going to happen. So this pain that is coming to Class B and Class C properties will not be sudden. You will have to follow. You have to do the work. You have to network. In fact, one of the things that I will do for my school community is I'm going to get either Jonathan or Anna or both who play in this space more than me to talk to the school community about how to find them, right? Because if you're in single family, you might be leveraging a technology called PropStream, which I use and many of my friends use. But that is very much single family. It allows you to figure out the debt, when the debt is, the rate, all of that. That doesn't exist for small multifamily. So we're going to find out how to find that data. We're going to ask some experts in that area. But again, most people out here in YouTube University are still talking about the single family housing market. It's not coming. It's certainly not coming in 2025. If you want to talk 26 or 27, we can have that discussion. But if you want to know where the crash, the pain, the value destruction is coming, it will be in commercial real estate. Because, as Ken McElroy said in point 1, the properties were snapped up with 4%, interest only, variable rate, bridge debt, and the debt is coming due. There's over $1 trillion in this debt. And if I am right about rates in 2025 and rates are over 7% for the year, banks are just going to go, I'm done. I give up. I'm out. And that's where the opportunity for you and I comes. So again, I want to shout out Ken McElroy for saying so eloquently what you and I have been talking about for 18 months or so. Let's talk about the economic week ahead. We got a lot of information coming. And of course, we've got the Christmas holiday on Wednesday. Hopefully you are done with all of your Christmas shopping and the like. Monday, we will get consumer confidence. Are we still seeing that Trump bump, as some people are calling it? Are consumers still confident? Tuesday, we will get new home sales. Remember, we got some nasty numbers from Lennar last week. Basically, Lennar said we're going to maintain unit count and we're going to eat margin. So it will be very interesting to see what new home sales are. We also get durable goods, those things that last more than 3 years. Wednesday will be the Christmas holiday. Hopefully you all have a wonderful day, make lots of memories, and smile, smile, smile. Thursday, we will get initial jobless claims. Again, we are watching that. Last week, we reverted back to the 220 line. I think it was 222, if memory serves, down from 242. So again, we are kind of bouncing in that okay area. And then Friday, we will get advanced retail inventories. So again, a lot of stuff happening next week as we head into the end of 2024. Folks, do me a favor. If you have any interest in joining my school community, I'd appreciate it if you would do that. We are 7 people away from 350 people. Again, being in a community like One Rental at a Time with all the go-givers and the ability to post questions, comment, get all the free education, join the live streams, easily worth 67 cents a day. That's all it costs. So if you could join school, that would be great. It would be such an accomplishment to get over 350. I would appreciate that. On Friday, we did get the PCE numbers. Again, the inflation numbers came out. They were generally better than expected. PCE headline was 0.1 month on month versus 0.2 expected. Excuse me. Core, same thing, 0.1 versus 0.2 as expected. Headline was 2.4 versus 2.5. You guys catching the drift, slightly better than expected. And again, core year on year was 2.8 versus 2.9. Yes, weekly unemployment claims was 220 last week. Before was 242. I have that here. We did get another follower, Jared. Jared was doing the work. Follow up, got a $600,000 property for $520 with $15K in concession. So basically got a $600,000 house for $500,000. Again, offers, follow up, check-ins. It's the easiest time ever to find motivated sellers. Dave Ramsey came out with his 2025 interest rate projections. Dave Ramsey does deserve a lot of kudos because his housing call in 2024 was dead on. No crash coming. Dave Ramsey says that mortgage rates will taper slightly by the end of the year, but will not change drastically. Again, if you don't recall, I am calling for a 7% average for 2025. Apollo Global Management, Apollo Global Management. Remember, folks, Apollo is the team that called for a 10% increase in single-family homes next year. They were clearly the outlier or the bull case for single-family homes. That was all collected by Lance Lambert at Resi Club. Apollo Management Chief Economist Torsten Slock thinks that we are going to have a strong economy, lower taxes, higher tariffs, and restrictions on immigration. And what does that all lead to? Torsten is calling for a 40% chance that the next move in interest rates is higher. I think that is a ballsy call. You know that my call is for no cuts in 2025. Certainly no cuts for the first half. But Torsten goes an extra step. He is saying that there's a 4 in 10, or what would that be, 2 in 5 chance that the next interest rate move is not down, it is actually up. And again, you could kind of get there. What I am noticing is we are having kind of bifurcated calls for 2025. We are having folks like Apollo Global Management basically say 2025 is going to be an amazing economy. And then we have a bunch of folks saying it's all going to implode. Nobody's kind of in the middle as of right now. So it'll be interesting to see what happens in Q1 and Q2. Ed Yardini is also captured as saying that the chances of getting 0 or maybe 1 cut are much higher post-Fed meeting than pre-Fed meeting. Ed, if you were listening to me, you would have known that was coming long ago. He expects economic growth to surprise the Fed to the upside. Again, Ed Yardini is a lot like Apollo Global Management, basically saying he thinks that the faster growing economy, aka GDP, will force the neutral rate. Today, the Fed thinks it's 3. Ed thinks it might be 4.5 or 5. Think about that for a minute. I thought Michelle Bowman was aggressive when she thought the neutral rate was a 4. He's saying it might be 4.5 or 5. If Ed is right, you can kiss rate cuts goodbye. And as Torsten and Apollo Global Management indicates, the next move might be higher, not lower. Don't forget, we have our One Rental at a Time celebration in Vegas. Seats are selling fast. Make sure you get your seats. Again, it is President's Day weekend. You're going to see all the millionaires there, be able to ask them questions, network. Really set yourself up for an amazing 2025. Make some new friends. We are putting on an event for couples, for new investors, for folks stuck in the first 5 years. It is going to be the place to be. I hope to see you there. Go get your tickets on Eventbrite. And of course, help me get school to 350 members. I would greatly appreciate it. We are 7 away. Anything else want to talk about here? Nope, I think that's good. You guys have an amazing day. Don't forget, it's Christmas on Wednesday. Make some memories, smile, take some pictures. Just celebrate the end of the year. We've done a lot together. And I will be back tomorrow morning. Take care. Bye.